A hearty welcome to the viewers, and we welcome you to the risks or the caveats of REIT investing. The first part, which we've already covered, was about the implicit risk. This is about what you need to take care when there are certain stated positives that we have for REITs. So there are a lot of positives that a lot of us talk about, and what you need to really care for as an investor when you invest in REITs is what we talk about here. So REITs, as a summation, REITs help you buy properties through stock exchanges, and with REITs you hold property and become a part owner, and they can be bought and sold like regular shares. So this is the brief outline of what REITs are for the uninitiated, and you can visit our website and connect with us through various ways. Now, the first point is that a lot of us say that REITs are extremely liquid instruments and they're fantastic alternative to buying physical property. You can buy and sell them in the stock exchange today through NSE and BSE and through your normal trading accounts. So the other point that to look at is that illiquidity can be a real boon sometimes. In fact, a lot of times. Now, what does an illiquid asset help you do? First of all, it gives you do not give into the temptation when the markets go up. An illiquid asset like physical real estate helps you do that. Whereas in case of REITs, if you see the markets jump up, you may just be tempted to sell the REIT. In case of an illiquid asset, you get time to think before selling, and that's a very, very positive thing. How many times have you experienced that when a certain stock has gone up, you've sold it and then it's gone up even more after that? So illiquidity gives you this kind of time and not yielding to temptation. So that's why I said that it could be a boon too, which real estate a lot of time provides. The second part is that REITs, no bulk money is required. We say that we can invest in small portions and liquidate in small portions because they are listed in NSE and BSE. But bulky investments can also help. Why? Because a lot of times the big family decisions are about not selling unless the family needs a lot of money. And you must have seen that a lot of families hold real estate for generations. Now with REITs, that could be something that may not happen. So people can, if for small needs one could liquidate risk and take out money and so on. So it does not, what these two factors about illiquidity and bulk money which is there in real estate but not in REITs, this is what it could result in. So real estate is actually, because of these two things of illiquidity and bulk money, which REITs are not, they are usually held for several years, and this gives a phenomenal return mainly due to compounding power. We all know about what compounding power is, and I think it's all pretty common knowledge today, but you could just search it a lot more on how compounding power really plays the main role in investing. And then REITs, and we may not sometimes give this emphasis to the compounding power because we calculate our returns very easily on the calculator and see this is the return I'm getting. But in real estate, these two very factors which seem bad can really play out well in the long run. So that is one thing one has to take care of in REITs, that if we are substituting to some extent our property investing with REIT investing, not yielding to certain temptations or not taking the power of compounding properly. The third thing is the transparency. So we say that it's a lot more transparent, and there are but obviously the pricing of underlying assets is very crucial. So you get to know what the REIT price is in the stock market, so whether a company which is holding commercial real estate right now is it valued nicely or not. But then the transparency of the instruments really is dependent on the real estate, which is the underlying asset, and they are not totally accurate. The underlying asset valuations may not be totally accurate. However, there is a silver lining that REIT valuations are mandated periodically. So SEBI is already has already issued guidelines where valuations are done by independent valuers, designated valuers periodically, and because they are income generating assets, they are more accurate than several others like vacant land or speculative properties. So they cannot invest in speculative properties, and they're rent generating. So to that extent, the valuations have some basis. The fourth one is about tax efficiency. So the instruments are tax efficient, as we say. Yes, they are tax efficient. I'll put in a little more detail on this, but first let me just tell you that you can connect with us through various ways or sign up on our website, or you can connect for one-to-one sessions also on the trainings page on our website. So the taxation part, we know that recurring incomes are tax efficient, and Mindspace and Embassy today have more than 80-90% of their recurring incomes which are not taxed. And we also know that long term, and we've made a separate video for this, how taxation in REITs happens. You can have a look at that. There are 2 videos on this, and also that the long term gains are like stocks, and above rupees 1 lakh are taxed at 10% plus some surcharges and all. So but what is not available in case of REITs is that there are several capital gain exemptions which are there when you buy and sell residential land under, say, section 54. There are residential agricultural lands which are exempt in various sections. The second part is that there is a time period which is different. So in case of REITs, the time period is 3 years. It's something like your debt mutual funds or debt stocks, debt instruments. But in case of properties, this period, the long term period, is defined as 2 years. So that's a little different. So you need to take care of these things when you invest in REITs. As a summation, we can say that one needs to be aware of some hidden risks which are there in the stated REIT positives. Number one, liquidity. We can erroneously give in to profit booking temptations. Number two, we could also sell REITs in parts to fulfill small needs, and that really reduces the compounding impact benefits that you get in real estate. 3, there could be transparency in the stock prices, but there could be a lot of divergence also with respect to the underlying values, because the value of REIT stock is a combination of the 2 things: the stock market as it factors in the demand and the supply, and secondly, the value of the underlying properties. Fourthly, the taxation aspect has to be completely evaluated as per individual situations. So there are some ways that could suit a person who's investing in REITs, whereas some property related taxation incentives may not be available for REITs also. Thank you so much. Do stay connected with on this email ID. Thank you so much.